Let me tell you a story today. I started investing back in 2019. I had an economics background, but as a new investor, I had no market skin. But I was doing good, so naturally I felt like a genius. But then March 2020 hit. My portfolio, which was roughly 3 lakh rupees, in a matter of weeks plummeted by 40%. They say it's not really a crash until you feel the physical urge to sell everything. And boy, did I feel it. I watched my precious 3 lakh rupees burn down to 1.5 lakhs. I panicked, I lost sleep, it felt like the world was ending. And then I sold everything at what turned out to be the absolute bottom. Literally the next day, recovery began. I eventually FOMOed back in and repurchased my entire portfolio at about 2 lakhs. But that 50,000 was the tuition fee I paid to understand how the markets actually work. At that point in my life, I was still a student and I had no income source, so that blow felt personal. Since then, I've been obsessively studying stock markets, looking at past cycles, trying to figure out how to protect myself in such situations. And it took time, patience, and a complete reset of my mindset. But this time around, this crash or drawdown or pullback or whatever you want to call it did not bother me as much. I know, like me back in 2019, many people today might also have this constant question in their minds. Have we already seen the bottom of this crash, or is it going to fall further? And I can tell you right now, I do not know, and neither does anybody else, except maybe totally kidding. What I do know, however, and have come to accept is that market crashes are not anomalies or crises. They are just a part of market's natural rhythm. So here are 4 verified principles to navigate this rhythm, also known as volatility, without losing our minds. Hello everyone, I'm Avani. Welcome to the next big thing. If you are new to my channel, please subscribe and help me reach my target of 5,000 subscribers by June. Here at Next Big Thing, I'm building a community of serious investors who, like me, might be looking for the next big multi-bagger opportunity. And if you are that person, you know what to do. Okay, let's get into it. The very first principle is don't ever be a forced seller. The biggest risk in a crash isn't a price drop. It's being forced to sell in that drop because you need the cash. And this only happens when you invest leveraged money or money tied to short term needs. As Charlie Munger once famously said, there are 3 ways a smart person goes broke: ladies, liquor, and leverage. I can't imagine a lady being the reason I go broke, but maybe my husband can. Who knows? But on a serious note, if you're over leveraged or dipping into your emergency fund to buy the dip, you lose the luxury of patience. So the rule is only invest capital with a minimum 5-year investment horizon and maintain at least a 6-month emergency fund. If you don't need the money today, market's daily red candles cannot hurt you. Second principle, conviction is key. Most retail investors trade on news, but news changes every hour. Fundamentals don't. Ask yourself, do you actually understand the businesses in your portfolio, or did you buy them because of influencer hyped it up? To stay disciplined, I keep an investment journal. And you don't have to keep a physical book like I do. There are lots of tools available these days. You can do it on Screener or Excel sheet or many other tools available for you to do the same. But the important thing is every time I buy a stock, I write down in my investment journal the reason why I bought that stock. For example, I might write, I am buying company X because they control 20% of the GLP-1 market with a 30% net margin. When the market bleeds and you feel like selling that stock, refer to your investment journal. Has the company's earning power changed, or has the management jumped ship? Basically, if the company is still making money and the reason you bought it hasn't changed, but the price is falling due to macro reasons like maybe global tariffs, geopolitical tensions, or whatever other reason, your thesis is still intact. So trust the numbers. But market crashes aside, it is a good policy to keep doing this exercise on a regular basis, maybe quarterly or half yearly, so that you can stay on top of things that might actually affect your thesis. Now, third principle is systematic rebalancing over market timing. If you are living through this crash, you should by now know that you cannot time the bottom. So use asset allocation. It is an excellent mathematical way to buy low and sell high without the emotional baggage. Imagine your asset allocation target is 60% equity and 40% debt, gold, and other instruments. By the way, refer to this video if you want to know more about asset allocation. Back to our scenario, if a bull run pushes your equity to 80% of your assets, sell the excess equity and move the money to gold, debt, and other instruments. This way, you just sold high automatically. Conversely, during a crash when equity falls down to 40% of your assets, sell gold, debt, or other instruments and move the money back to equity. You are now buying low when everybody else is terrified. Your investment journal will help you a lot in this exercise. With this, we are at the fourth and the last principle, change your mindset. Historically, high quality companies don't just recover, they lead the next cycle. In a crash, the stock of a good company isn't falling, it's on sale. But because we don't know when the bottom is going to be, dumping all of your money at once is not a good idea. It might make you miss out on an overall lower average buy price. At the same time, doing nothing and waiting for it to fall further or reach the bottom might make you miss out completely. So, the best strategy is using a staggered approach, SIP or DCA. The rule is keep accumulating little by little as the stock falls. Now, you might be thinking, but Avni, what if this time is different? What if the market never recovers? And trust me, I was thinking this too when I started on this journey. So, the thing is, while historical performance does not guarantee future results, there are clear indicators that will help you distinguish a cyclical correction from a structural breakdown. A few signs that the market is healthy and will recover are core economic activity continues. People still buy groceries and iPhones. The banking system remains liquid, and central banks and other authorities are actively taking steps to stabilize the system. In stable economies like the US or even India for that matter, this pattern is highly reliable. However, you should be deeply concerned if the entire financial infrastructure starts failing. Banks become illiquid, they start closing doors. There are frequent bankruptcies everywhere. The country starts defaulting on its sovereign debts, etc. Take, for example, the 1989 Nikkei crash in Japan. That wasn't just a dip, it was a massive property bubble with shrinking workforce and extreme valuations. The PE ratio of Nikkei hit roughly 60x before the crash. For comparison, the BSE PE was around 25 to 30 before this crash. It took them nearly 2 decades to recover because the structural foundation was broken. A crash is just like a season change, it rebalances the market. Unless the world's economic engine seizes up, in which case your portfolio will be the least of your worries. Recovery is a historical norm. To survive and to profit, stay calm because opportunities live in the red. Stay liquid, never be a forced seller. Stay informed, always know the why behind every buy. And obviously, stay invested. If you found this video helpful, smash the like button and subscribe to the next big thing. And I'll see you in the next one.